So thank you for listening in on this talk. This is a project that I and this group has been working on for quite some while, at least a couple of years. It's all partners in crime, so Casper and I have been working together since I was an undergrad 20 years ago. And Kim and Steffen are new partners in crime. So this paper is basically a simple measurement exercise. It's not about identification in this paper. Though I have cancer papers with Kim, then it's not about cancer. But it is about beliefs. So Kim and I had this discussion about, in a different paper, about how beliefs can explain trading behavior. And of course, we can all have different beliefs about whether stock markets are going to go up or go down. But what our interest is in this paper is how knowledge or the ability to predict changes for the future affects the way that you trade. So not us, others has called this extrapolators, contrarians, or forecast bias. So those of you who had finance have these momentum strategies, this position effect, all these ideas come from the idea that we think markets are going to move in a different way. And all we want to do in this exercise is get a measurement of people's ability to predict movements in the market, and then see how that correlates with how they trade in the financial markets. So, simple idea, simple exercise. So, we're going to do it, so I just told Uli before the presentation that his keynote speech has a title of something that we're doing in this exercise. We're going to do a lab experiment to capture people's ability to forecast. We're not so interested in like how precise they are, or sort of exact numbers. All we want is a ranking. So you can think about this as 15 years ago, we measured risk and time preferences, and then we correlated on how people behaved in the field or in the lab. And we're not so much interested in whether risk aversion is 1 or 2 or 3. We're interested in the ranking between people. So we get a prediction of, do more risk-averse people behave this way, or do more patient people behave this way. And it's a little bit the same here. We want to bring people into a lab to be able to elicit their ability to forecast, and then see whether their ability, whether they're extrapolarian or contrarians, predicts the way that they behave in the financial market. So we're going to bring them into a lab experiment, then we're going to link it to administrator on how they trade, and then we're just basically going to test whether we can explain how they trade. Okay, so let me sort of explain the two biases we're talking about. One is that you have a tendency to think that, like the momentum strategy, that if things goes up, it has to continue to go up. You're extrapolating too high, right? And the other bias we're talking about, this is contrarian biases, where you, in the literature of disposition effect, is mean reversal bias. If you think something is going up, it has to come down. Right? Not ignoring what the real process of data generating processes is. If we take this to the financial market, then if you think you have the extrapolarity bias, then past high returns on the stocks makes you buy it because you think it's going to just keep going up. Right? But if you have the contrarian bias, then you should sell your stocks that are going up because you think they're going to mean reverse and go back. So the contrarian bias is a type of explanation of the disposition effect, right? It's extrapolation bias, is momentum strategy idea. Okay. So this idea of extrapolation bias is not new. It's if you think about sticky prices and house price movements, it's been around for a while that we think that these movements in prices are not we actually need. Right? So there's some stickiness we have, like an idea that these will move in waves. And the last paper that we're going to use, and we did not know that we're going to publish so nicely, is this paper by Andersen, Landier, and Rantisma that got out in the QJE. That it basically is measuring these forecasting biases. So we did the experiments 3 years ago. 2 years ago. And by picking up, okay, this is a really cool measurement of forecasting biases, we're going to employ this and then see whether we can use this to predict how people trade. Okay, so in a nutshell, our paper, our research strategy is to take the lab, make a measurement, and then predict using the administrative data, that like the Scandinavian data. While I was listening to the presentation, I was actually going, why don't they use the smoking behavior from the birth certificates? It always says in Sweden whether the mother or father smoked or drank. But I guess I thought about that. Okay, so our sample, the way we're going to do it is in Denmark we have no secrets. That's always the joke. Scandinavia, it's like big brothers watching your country. So you can go to Statistics Denmark and say, I want to do an experiment on a specific group of people. You can go on people who have had cancer, if that's what you want to do, or criminals, that we've also done in Denmark. But in this experiment, I wanted to do it on active investors, or people who invest in the market. So if I do a random sample of the Danish population, only 23% of the population actually has assets. And very few of them actually have anything that is uniform. So in this, like, because I get 18-year-old in, so usually they don't have stocks. Right? And if you're 90 years old, you usually liquidated most of it and spend it. Right? Or hopefully you did. So what we do here is that we wanted to have a sample where we could look at active investors. So we picked people between the age of 30 and 60. We also wanted them to be within a 45 minutes drive of Copenhagen, because like if you ask people to drive too far, you have a sample selection problem, right? People don't show up, the opportunity cost of showing up is too high. And then we also said we have to be a homeowner for at least 2 years in the period between 14 and 18, and have at least 10,000 kroner in assets. So 10,000 kroner is not that much, right? It's not like typical high investor, but we at least have something. We didn't want to only have rich people, so we took the 1,500 euros, that's 31 years. So we end up with these 75,000 people that we can invite. Out of these, we invited 24,000, and then out of these, 1,000 would show up. Now one could say that 1,000 out of the 25,000 is like a pretty big selection problem. So what we go do, of course, is do some randomization in the invitation, so we can do a Hekman selection in how to do that. But that's what I have. So the lab experiments is a super simple experiment, and I will show you the task. I think it's simple, maybe some topic didn't find it simple, but at least this is how we can elicit this virus. We ran 24 sessions before the COVID. Then apparently Statistics Denmark didn't want to do during COVID. So we had to wait with the last 12 session until they opened up again. There's a 10% chance that all of these experiments are incentivized. So it's hopefully money is on the line that they respond truthfully. They have a 10% chance of receiving either 1,000 or 2,000 kroner to show up. The reason why we do this is the Hekman selection, right? So if I send half of the subjects 1,000 kroner to show up and half of the subjects 2,000 kroner to show up, whatever fraction, the difference in fraction, I can use as my substance variation for the selection process. Okay, we do a bunch of controls. Basically, this is like the idea, I call this my consultancy slide. And basically when we talk about beliefs and expectations, we have this idea of you have a belief about stocks going into some range. I think that Facebook is going to end up at 110 next year. In this process, you have information knowledge, and then how you process it. What we're trying to measure here is your ability to process that information. And the paper, the paper by Afusi and his co-author is basically they see subject sees a series of outcomes, and they have to guess the process. So it's an AR process that we learned from the econometrics and time series. We picked one of the series from Bruce's paper. I had an idea in the room when I presented this a couple of months ago, and he says, you picked the one with the highest power, how did you know we didn't write? And he said, that's certainly you just picked one. We thought it was easy because in this process you're supposed to know that you're going back to 100. So when you see numbers between 0 and 200, you're supposed to know that the process is going back towards the mean. And when you see the first 40 observation of these random draws, you're supposed to take that information and then make your best guess of what the process is. So let me show you the experimental task. This is what people see. So they see the pre-period, and it's ticking like a price on the screen for the subjects. So 100, 108, 142, 150, 153, and then it ticks the numbers off, and then it ends on 121. And then the experimental task is to say, if you guess what the next number is, and if you're correct, I'm going to give you 2,000 kronas, and for whatever deviation you are wrong, I'm going to subtract a little bit of the money. We pay by the points, so we get rid of risk aversion. In some settings, well, I'm not here, so I can say that. But in theory, you should get rid of risk aversion when you pay by points. But then the rational forecast, and I'm going to come back to what I mean by rational here, is that you should guess the next number is 110.5. This guy picks 80, and then he says 2 periods forward, it's going to be around 100. Okay. And then once they click the OK button, it goes, no, the number was 90. So it's not quite what you guessed. You guessed 80. So you're 10 points off. I'm going to pay you off compared to that. And then you have to guess. And then they have to keep guessing what the process is. So that's basically a measurement of being able to forecast. Now, the way we're going to use this data is to say we're going to have a measurement for each individual. We're going to measure forecast bias. The forecast bias is how far off you are guessing the process. And we're going to standardize this as initially in the start of the presentation. I said I don't care what your bias is. All I care about is where you are in the distribution. Okay? So I'm just going to rank people and standardize them. If you have a 0 in your forecast bias, then you get the process right. If you're positive, then you are extrapolating, and if you're negative, the contrarian. I made this graph up because I think it's easier to understand. Basically, the x1 was the realization, the number that the person saw. He saw 120. If he gets a guess 110, then he is unbiased, because then he guessed the process. If he adds, put any number above that, he's extrapolatarian. And if he's below the 110, he's a contrarian. And the reverse, if he's below the mean. Okay. So we are agnostic about the right model. So the QJE paper, they had like 6 different models of how people form expectation, and they do a horse race to figure out what is the best model of expectation formation or bias measurement. They're all highly correlated, so when all I'm caring about is the ranking, it doesn't really matter which one I pick. Right? But I'm just going to take the extreme symbol of this rational expectation that actually ignores that each person has a different set of information, that each process is different for each person. So each person should have different predictions depending on what path they saw of realization. We're just going to ignore that for the basic setup and just do rational interpretation, rational forecasting, and see how biased you are compared to that. Doesn't matter, which I will show later. Okay. So that's the measurement we're going to use, and then see once I've measured how biased you are, whether you're contrarian, whether you're extrapolarian, how does that fit with the way that you trade in the stock market? Okay. To give you sort of a measurement over the 900,000 people, then a little bit over the average is explorers, and of course the residuals are the contrarians. So people are a little bit on average seems to be forecasting too high. Okay, so once we have two objections here, several. First objective is to show who are the biased people, who are the ones who don't get this prediction right. And then the second part is to sort of explain the trading behavior, or whether our measurement of this trade can explain trading. So for the statistics Denmark, so we just saw the other Scandinavian paper, you get age, education, gender, marriage, total finances, total housing, assets, labor, income. This all comes from tax authorities or the Social Security sort of data set. So nothing sort of out of the ordinary there. What we collect in our experiments that we don't get from Statistics Denmark or Statistics Norway or Canada is these measurements that could relate to how you trade, but is not something that admin offices register. So one is, for example, financial literacy. The keynote lecture from last year was Anna-Marie. The SARDI has its financial literacy measurements. You don't get people's numeracy, or you can use people's math rate. It's not quite the same. Right? You don't get a measurement of overconfidence, optimism, risk aversion, and trust. So the trust question is Luigi's measurement from 2007. How much do you trust? It's like life at scale. The risk aversion is from Wacker's series to sort of get a sort of semi-precise estimate of how risk averse people are. But that's what we, additionally to this bias, collect in the experiment as control variables. Okay, so results. Who are the extrapolators and the contrarians? So what I'm presenting here is a table where we're trying to split who are below, like who are the really contrarians, who are, we don't really know, because we know that we measure things like the bias with the noise, and who are the extrapolators. Across these, we're testing whether these groups are different. So is a different group that we can say behave differently? So is it people with high income that are the extrapolators or not? And we don't find that. Is it people with high financial or housing wealth? All these characteristics is not really any difference. I know there's a significance on age and education, but if you look at the numbers, they're not different, right? So they're not economically different. One only thing that you could sort of say that there's a difference is this numeracy, the ability to pick numbers. So this is question when it's like 10% out of 1,000 get sick, how many get sick, and then there's like 100 or 10 or 1, and then they have to pick the right number. But all in all, there's not an observable that we can say really predicts who are the extrapolators and who are the contrarians. Now, the main point of the paper is to say, let's take this bias and let's see whether people trade. So when you read papers on disposition effect, it will say this behavior is coherent with people having mean reversal beliefs. Now, what we're trying to do in this exercise is to show, is that actually true that people who have this mean reversal behavior actually trade this way? So the hypothesis is people with higher forecast bias pick stocks with higher past fixed return. We're going to test that. The way we're going to test that is Scandinavia. We have all tradings of all people in Denmark. We have all their asset holdings, whether it's bonds, mutual funds, or financial contracts. So we're just going to basically say you're going to buy stocks that has a high excess return. That's to get rid of market timing. We use excess return on the stock. And then basically say, explain that by our measurement of forecast bias. So if people who have extrapolates, they should have a positive coefficient on this. What we get is that our forecast bias that we measure has a high explanatory power on the people who have this forecast bias actually buy stocks that used to have high return in the last 5 period. The interpretation, because we standardize this, is that a 1 standard deviation increase in forecast bias is a show with curves to start 3% much higher excess return. So it seems like the people who are extrapolating are looking at the stock market and then they're buying stocks that did well. But of course, this is symmetric. It also means that the people who are contrarians buy the ones that did badly. Alright. Then stock sales is the other side of it. The hypothesis here is that if you have this bias, extrapolators should sell low performance and contrarians sell high performance. Here we have to do it a little bit differently. So because instead of using monthly data, we're going to do it within a day. Because we have, when you sell stocks, it might be for a liquidation reason, and you might need the cash. So each day we're going to look at the performance of your stock previously within that day. So if you have to liquidate $100,000, you're going to pick the ones that have a high performance or low performance out of your 1 million portfolio. And so it's within day sort of analysis on sales. Okay. And what we get is that prior excess return doesn't really explain anything, but coherent with this disposition effect type of argument that people look at what the capital gains are on stocks, the realization utility sort of idea, then the asset that has the highest capital gain on it compared to when they bought it are the ones that are being sold by the people who are extrapolating. Okay. So we have this, we can show both of these hypotheses, both on the buying side and on the selling side on individual assets, not on the market level, but the individual assets. So people who have this bias pick portfolios depending on performance of the stocks.
Sorry, can you explain again when you do the test for buy and sell differently?
So when you buy,
okay,
then you have the menu of, we can use the menu, you buy from this universe of all stocks in the world, and then we use the excess return. Okay? When you sell, you can't sell stocks you don't have. So there we have to do the analysis within the stocks that you can sell. So that's why we split.
okay.
If that makes sense. Yes. And then the last thing that we want to show with these purchasing or asset allocation decision is the net flows in and out of your portfolio size. Because you could also have money in cash or put it into your house or whatever else you do with your portfolio. But here we want to look at, does this bias also explain when people go in and out of the market? So if you have this extrapolarian, contrarian bias, then when the market has been going up, you should have a net outflow because you think the market's going to immediately reverse. Right? So what we do is we take the value of bias minus the annual sales, or the total value of stock portfolios, it's net flows, and then we basically just explain it by market returns. Whether there's market return, excess market return, and the interactions. What we can show, or what we show in the paper, is that this forecast bias also explains entry and exit into the portfolio market. So it's not it's about if you have this contrarian bias, then what our results show is that you get out of the market once you start doing it. So it's the measurement that we're getting, or the trait, this bias, extrapolation bias that we get, explains both buying and selling of the single assets, but also flows in and out the stock market. Okay, so basically, purchase are sensitive to past events, sales are sensitive to past capital gains, and net flow sensitive to market terms. Now, the last thing, second last thing I want to show is that this trade is very stable. So one of the concerns that we had when we were starting is how much does prior experience change this? So if we want to explain people's trading behavior, we have to have something that is a little bit constant. So in the last presentation, somebody said, what if risk preferences change? Now, preferences, we would like to be stable because else we can explain everything. Right? It's Gary Baker's argument, right? So if we're picking something up here that is flying all over the place, then we're not really, we can't use it to explain very much. So what we want to show with this way of analyzing our forecast phase is to show how stable it is. That very few previous experiences actually change this forecast bias. We're going to show it by insignificance. So the stock holding during past market crashes, for example, is we know whether you hold stocks in the 87 crash or the 96 crash or 2007 crash, and then we can use that. Did that experience, does that correlate with what we're measuring as this extrapolation bias, forecast bias? We also have stock holding or holding and trading experience because we know all the trades, so we can do a measurement of experience. We also have when company defaults. So we have banks and companies defaulting and people owning stocks in this, and we can use that as an experience to say, if we believe that this is a trade that is formed by experience, it should correlate with what we measure. Now what we can show is all these variables, plug them in and say, is anything significant in explaining the level of forecast bias? Only one of them is significant, but it has a wrong sign. So we're just going to ignore that and say, probably if one is significant and it's wrong, then probably there is nothing there explaining it. Okay, so the evidence suggests that forecast bias is a stable trade. Okay. And why is this important? It's important because then it's a measurement of why people make mistakes that we can't really change. Okay. Now, I start off saying that we can do different forecast bias measurement. So we do also the residual or the limit information. Limit information, this idea that Tuuli and I don't get the same information set. So if Tuuli's information was go down, go down, go down, go down, go down, and mine was go up, go up, go up, we have very different information sets about what the process is. And we would answer differently. So you could plug this into the model, and then it comes out with a different forecast bias measurement that if you take this into account. We do residual, limited, rank, diagnostic, extrapolative. The only thing that doesn't show up significant is this extrapolative measurement of forecast bias. We took it because it's part of the original paper. And if I go back to the dissertation slide, and maybe somebody was thinking, why are there 2 dots? Why am I predicting 2 periods into the future when we're only using 1 period for the data? For the extrapolative forecasting model, it needs 2. And it's just a very noisy measurement. So maybe if we had 5,000 subjects, we might be able to pick something up, but it's simply too noisy for us to pick anything up. I have more time. We also look at investor performance. So it could be that the people who have this forecast bias is doing worse or better. That would have been very nice. but it's not there. When I discussed this with some co-authors, I had a paper on these investment mistakes in Swedish data, and so even though you can show these investor mistakes, it doesn't cost people anything. So there's a very little effect on the alpha here, on what you get of returns. And then to sort of emphasize on the sample selection model, to say that this is actually representative of it. It's not representative of the Danish population. It's representative of the sample that we drew from, right? So it's all the ones that are investors in the Copenhagen area. We used two instruments. One was the randomized geography. So that's by invitation later to Statistics Denmark, or from Statistics Denmark to people. The second one is travel time to lab. Since it's random who we send letters to, that each person has a travel time to where the location of the experiment is. And then we can use that as an instrument to correct for sample selection. And yes, we have reached investors in all directions of Copenhagen. It's not just north of Copenhagen. But when we do that, we get exact same results. Yeah. So it's not that doesn't seem to be the sample selection effect we're picking up. And we saw this beautiful measurement of balancing in the previous paper. I've seen them before today. That if you have something balanced, you're okay. Here we definitely don't have anything balanced. But because if I show you this without having the Heckman correction, you could say you have serious sample selection problems because the samples are different. But because we can do this, we can solve. Okay, so conclusion to round up. On average, extrapolation bias for large heterogeneity. And this forecast bias is important. And it's a trait that is stable. It seems that there's the ability to forecast predicts how people trade in the market. Thank you. That's 5 minutes. I told you I was going to be less than 40 minutes.
Well, thank you, Steffen. My name is Jorgo Goossens. I'm at Radboud University and Tilburg University. And I also spent some time at the APG, All Pensions Group, which is the largest pension provider in the Netherlands. I had a pleasure reading this paper. I think I saw it at Tilburg being presented. I got a version from you in May, and then this week I got a version in July. There were all kinds of nice steps in this paper. And even now in the presentation there were some things that clarified some of my questions. You presented it at many seminars and conferences for what I could see from the acknowledgements, so I think it's a very polished paper. Nevertheless, let me show you some of my comments. First, I'll give you one slide summary. So why do I think this paper is important? So expectations and also preferences, I mean, they play a key role in trading decisions, and eventually I would argue they drive asset prices, right? So the two main things, what I think stand out for this paper is first you build on this growing literature, 3 strands of the literature regarding expectations and how to elicit these things, maybe forecast bias in this case, how does it relate to individual trading, and then also how can we use this in macrofinance models to eventually explain asset prices. The second thing, which I think could maybe even be emphasized in the paper, is that, okay, this concerns a lot of money, right? This should be 450 million total trading amount that it concerns for the population that you have. So I think it could even also have very nice policy implications. So what do? Indeed, very simple, straightforward paper. I like it. You elicit forecast bias in an experiment and you just relate it to experienced stock returns and see what happens. And your main conjecture is, okay, higher extrapolation bias results in buying stocks with high cost returns. That's the main gist of the paper. And then what do you find? Well, you corroborate this finding, and you also find quite a substantial heterogeneity in this focus bias, where about half of the sample is extrapolator and half is contrarian, like 60-40 in that direction. So let me then give you some of my thoughts on the paper in no specific order, but you needed to use this Heckman model to sort of get your results representative for Denmark. I was just wondering, why didn't you do the experiment online, and then you didn't have this hassle of getting participants to Statistics Denmark? To me, that seemed to be a thing, would have been possible given the experiment that you do. The second is, does it matter how investors interpret the periods in this thing? So you write you want to elicit focus bias in a general way. I do understand that, that's also very nice. But we also know that biases and preferences could be context dependent, right? So we also know from just returns that daily returns behave differently than annual returns. So I was wondering, does it matter for your elicitation here? Because I didn't see anything, I think, in the instructions about how to think about this, but that was a thought I was having. And the third point, which you briefly mentioned it actually, which was not in the paper yet, but I think that could be clarified, is you elicit also 2 periods ahead forecasts, and I was just continuously wondering why, and why not also study them and use them, but you said they are just too noisy for what you told now. Still, I was wondering, you show the participants, that's this little green cross next to the yellow cross. The forecast, the 2-period forecast we made in the previous period. I was wondering, does this work as a sort of reference point? It's a cognitive cost to deviate from this, right? If you want to make your blue cross, in this case, different. Is that something that plays a role in your elicitation? And I was also just wondering, these yellow and blue crosses, I mean, are they mostly in the middle or at the extremes? I mean, that's also partially in your forecast bias, but I was wondering when do the participants maybe click or make their estimate. So then you have this very nice graph where you show the forecast bias. So every one to the right of 0 is an extrapolator, and every one to the left is a contrarian. But the tail for the contrarians is 1.5, 2 times larger than the tail for the extrapolators. I was wondering why, what's happening here? Do you have any intuition for this result, or why are contrarians way more extreme than extrapolators, so to say? And then the 5th point, and I saw a table now also in your slides, which was not in the paper yet, but I was wondering, okay, how does focus bias relate to the individual characteristics, right? How does it relate to age, etc.? But you have a nice table there now. But still, these last bullet points remain. So I was thinking, subjects learn whether their forecast was correct, because you show that with that little green, with the green dots. Do subjects become better forecasters throughout the experiment, right? So can you see different types of behavior towards the end of the experiment and before? Because in the paper you use odd numbered periods and even numbered periods, but I was thinking, okay, what about the beginning of the experiment and the end of the experiment? Then the stability of the focus bias, which was also the new version of the paper that you sent me, I very much like that, whether it's a stable trait, yes or no. I was also thinking about this in the May version of the paper, but from a bit of a different angle, because I think it's important that you indeed try to corroborate whether it's a time invariant characteristic, yes or no, because the actual investment decisions, they are from 2011 to 2021, but the experiment you do is 2020, right? So it's sort of backward looking what you're going to do. But in this meantime, in this period of 10 years, quite a bit can happen, right? Also in terms of age, income, also at the household level. So could you give us some information there? Because now you look at investor experiences, but what is it more at the household finance level? Yeah, and then the COVID-19 crisis, because your experiment, interestingly, is actually in the middle of the COVID-19 crisis. And you say, okay, March 2020 is before COVID, and November 2020 is after COVID, but still I think that was in the COVID crisis. So there is some literature out there. I also did some research on that myself, that in this case, risk aversion, present bias, and the discount factor seem to fluctuate quite a lot during the COVID-19 crisis. So this is March 2020, from a paper of me with Marieke Knoef, exactly the same period as you. So we see that, for example, the present bias, which is also a bias similar to forecast bias, varies substantially with the COVID-19 hospitalization. So I was wondering, okay, you sort of look at the aggregate in March and in November in your sample, but what's the influence of the COVID-19 crisis on your forecast bias during the experiments? Maybe that could shed some light on how things behave there. And just to note, March 2020 there was this very huge drop on global stock markets, so that's maybe something you could also include in your trading analysis eventually. Then my final main slide with some thoughts. I think this table sort of gives the gist of the paper for extrapolators and contrarians, right? So you have extrapolators for about 50% of the sample, and then contrarians for less than 50%, 40%. So an extrapolator is buying or holding winners and selling the losers. That's basically the main idea. And then for the contrarians, you do the opposite. They sell the winners and they buy or hold the losers. And especially the contrarians, I think, you mentioned it now during the presentation, but it was not so much in the paper yet. The contrarians are actually that's just a disposition effect, right? So I was wondering, these contrarians, are you having a micro foundation for the disposition effect there? I think it would be nice if you include something on the disposition effect. And the final thing, that's point 8. You show a lot of tables on trading, but I was wondering, to what extent do the current portfolio holdings of the investors matter? So, if the individuals buy stocks, are these stocks already in the portfolio and do they just buy more, or are these new stocks, and how is the overall portfolio composition changing? Given that you have so many data, maybe you could show something on that as well. And then I have some remaining thoughts, but I can share them with you. These are just very minor things, but my time is up. So I very much would like to thank you, and I hope it helps, and good luck with submitting the paper and publishing. Thank you.
Thank you. I'm going to need the slides to answer half of. I would love to, so we didn't want to do a COVID treatment. That's why we don't mention it.
Yeah, I was already thinking about that.
But well, it's easy to do a before and after period. So going back to this, so I didn't mention it in the presentation, but one of the ways that we check the stability of the trade is also if you take all the even periods and estimate it compared to all the odd periods, and then within person, and then see whether it's constant. And there's a very high consistency of the forecasting bias within individual. But yes, we could also do a start period, end period. I think we already did. I remember it as we did, and there's no difference. So but I'm not 100% sure. I would also love to do something on the disposition effect. The problem is that my challenge is that then gains are too boring. In the sense that this disposition factor Barbara Odin finds in the American data and the discount brokerage that they do, I can also find in the discount brokerage and Danish data, but I can't find it in the other. Does that make sense? So and they're a smaller part of it. So it's there, but there's not enough going on. What else did you have? I will look at this. I doubt that I doubt that we'll be able to find anything, but I will look. Yeah. I would also like to comment this, the number 4, because I can explain why. I don't know what I will do about it. What I found with the many experiments that I run at Statistics Denmark is that subjects has a tendency to some subjects has a tendency to click to what is closest to the OK button, and that gives potentially could give it a tail in the bottom half. I don't think it matters for the sort of ranking and its noise, but that would be my. It's not something that I tested, but that would be my gut feeling.
And
Why
if you throw out these individuals that just then...
Yeah, but it's not that because they have to fill something in, but then it will always be like in a pattern. Then I can check it, but whether it's that or whether it's something.
You should see it in the response times, no?
Yes. Then I can, yeah, that's actually a good way of checking. It could also be that you just do it quickly and that generates it. So why don't we do it online? So I also done online experiments with Statistics Denmark. The reason why we did it in person is this is a little bit more advanced task than lottery tasks and time preferences tasks. So I wanted to make sure that the people who were there actually understood it. Also because I can't, so I know that the original PGA paper is on MTurk, and there you can get 50,000 responders, right? And then you don't care about the noise. But MTurk I can't connect to the trading data. So I needed people that I could connect to the trading data. And then I needed to make sure that I can't, since each subject costs like $400 to invite and pay, I couldn't afford in my budget to do 10,000. So that's why I don't do this online. But with Glenn, we have these experiments on criminals, and Statistics Denmark refused to do experiments on axe murderers inside of, actually they didn't care about axe murderers, but they care about those people who were convicted of assault on public servants. They did not want those inside Statistics Denmark.
Everybody else is fine.
So that's the reason why.
And do you know whether they understood the task well? I mean,
No, we don't.
Is there anything
But,
okay.
but I know that they ask more questions for this than they do in the lottery tasks. And we even a year before we did belief questions in an experiments with Glenn, where it's like a distribution where they bet on future outcomes, and even there's questions. So after the experience, you always have the idea what comes out of it after the experience. I was actually not too positive that I would find any correlation whatsoever, because if it's all noise, it's all noise. Right? Yes. I think I will stop here, but I also would like other questions. Yes?
Just a clarification, I mean, your experiment, everybody gets the same sequence of
No.
but why don't you let everybody, so if you could run an experiment in which everyone has the same sequence, and then you can check whether
I know. Yeah.
Why did you do it this way?
Because I couldn't afford it. So it's
Or you can maybe have two,
yeah.
or just two sequences, and then randomly assign them to, anyway, because it could be that a particular sequence affects the proportion of contrarians.
Yes, but that's hopefully what we get when we do the
Or you
different
can
versions
repeat
of forecast bias models, because the other models of forecast bias takes into account that different people get different information.
Yeah.
So that was the hope that that would pick that up. But in the original paper in QJ, they also have like 6 or 7 different setups of payoffs and processes. Can't afford it. So I had to pick one and hope that there was variation enough in the measurement that it would pick up in the trading. You had a question?
Yeah, so two questions. So one was picking up on Tulio. So normally if you see a series, right, and you only have these points, and I estimate myself the process, and then I have a standard error over the parameters of the process, so my forecast is going to incorporate this. If everyone sees the same sequence, I understand that you can order people fine, but now they didn't see the same sequences, so you have noise a little bit, the measurement error in that forecast bias variable, right? So suppose I'm unlucky, I see a sequence that looks very correct.
Yeah, I know, it's a matter of control, right? So what you're saying is that I will get greater control, but then I would only have one sequence.
Yeah, but they would not communicate to each other during the
No,
trade.
it's not so much about the, this is 2 years ago since we were in Mexico.
No,
so
it's
I'm
okay.
pretty sure that we discussed it. There's some other, I can't remember the argument
So,
of why not to do it.
The other thing I was wondering, so experimenter effects here. So what do you tell them about what is the goal of the experiment? Is it that you're going to be running this forecast experiment on prices and then you're going to link it to their past behaviors? What do you tell them?
So invitation letter, what was sent in the invitation letter
Yeah.
is, so we want to figure out, that's not the language, but that is what we're saying. We want to figure out how people make financial decisions. And the trade-offs people do with when they make financial decisions. Very general. It's also when you say there's no time periods, there's nothing. It's about the ability to make financial decisions. Yeah, so we try not to frame it all. Purposely, we don't frame it. We just want a measurement that we think correlates with forecast bias. But also, I fully agree with you. There's super rich people in here, so it's amazing that people who have
Rich people show up.
rich people show up,
Really.
millionaires and billionaires, because they want to do it as like for science. I don't know.
The Danes are wonderful.
So yeah, so it's not trivial
Yeah.
pocket money people who they are also there, but it's not. And they do it because they want to show that they know something. The first experiment I did in Denmark, I had a member of parliament that used to be an econ professor. Then when he did the experiment, not this one, but the prior one, he asked me, why am I not allowed to be rational? Which, yeah, so people to show up, even though they don't show up, it doesn't seem that it's a representative of what we want. Yes?
Yeah. Do people click what their forecast is going to be? Do they have
Yes.
a touch screen? Is it with a mouse?
It's with a mouse.
Have you tried differential mouse sensitivities? So what I mean.
No, I haven't. But I think if I did it, if I knew how, so I coded the software and I find fault. If I had somebody else do it now, I would have it where they just put fingers on it, touchscreen.
Yeah.
And that's actually one of the reasons why we also didn't want to do it online, because you don't know the device that people are using at the other end. And that, and then you actually don't know who shows up. Right? So, who answered the response in the background. So it could be that if I invited a billionaire, he gives the task to his kid, and then he fills it out. But this is tied to your payments and your registration is to Social Security numbers.
So psychologists use something called mouse tracker that
Yeah.
actually collects data on the mouse movements and where they, like whether the person followed the line first.
Okay.
Like on future iterations that you use something of the kind, both varying or even
I need a
randomizing.
younger colleague on the coding side.
Yeah, well, it's a software. It will do it for you. It's
Okay.
connected to the mouse driver actually,
Okay.
and so it's collecting data from the peripheral that tells the computer that someone is moving the
Moving.
mouse. Yeah. So
That would get whether people are close to the OK button.
yeah, it will tell you like X and Y coordinates of
Yeah.
the mouse in the screen, and you might be able to vary the mouse sensitivity as well, and to kind of
Figure out what is
even like
driving
a methods paper for folks that do this. Like, folks, these things matter. look, your results might be influenced by this. You just have to clean it.
That's future. Yeah.
So a couple of questions. If I did not have access to wonderful Danish data where I can experiment, and I just have access to trading data,
Yeah.
there's people that try to classify people as contrarians or forecasters based on actual trading data or actual events.
Mhm.
How wrong would I be? Because now you actually have a measure. You actually have the data to do. So if you do the classification problem.
I don't know, but it's good. You could do the reverse engineering, yeah?
Yeah, and see of how much noise is in actual trading data that generates anything meaningful.
I don't know, I haven't done the exercise, but yes, you could look at trading data and then classify people after this method and then see how it falls into, but we haven't done it.
No.
Yeah.
The other is that among retail investors, there's some people that believe in the technical analysis of stocks. And there could be a simple survey question of how do you actually in your trading, do you try to detect patterns?
We had survey questions, but I don't think we asked people whether to do technical analysis. We have other type of investments I could do. It's, as I recall it, don't hang on. It's like, do you actually do your own investment or do the bank do it for you?
No.
So you could have a managed account. All I see in the trading data is, right? So those type of questions, but not which type of investment strategies that they follow.
Because it could be interesting that those people that have experience with, say, trying to find patterns.
Yes.
I'm not sure that they would do better in this task.
I don't think so either. No. But we don't ask them. Also because to many people in that room, they would not know what technical analysis is, right? Or if I ask them, do you do momentum investment? 2/3, no, 9/10 of the people in that room would say, what is momentum investment?
For policy, is there anything that because I know that some countries they ask about risk aversion collected as if you want to invest in stocks first you need to say how risk.
That's a MiFID regulation. All banks have to do it now.
Would this make sense to add it to the portfolio?
So I don't think so, but that's a political. The MiFID was a disaster for people's investment behavior, but that's a different discussion. Any other questions? No?
No,